Welcome back to another edition of Fun Friday with a special guest, of course, a friend, a partner, a gentleman who's in many of the communities that we're in at Lone Star Capital here. Welcome to the show, Fun Friday. Tait Duryea, founder and principal of Turbine Capital, who has a very unique background. Not only is he a elite capital raiser for real estate private equity deals and such, and other things we'll learn here on the show, but also you have a kind of a unique background with your being a pilot and whatnot. So welcome to the show.
Craig, thanks for having me on. Appreciate you extending the invitation.
Absolutely. Well, you're also a fellow podcaster. Obviously, you've got your setup here, right? So you're no novice at all in the space, of course. And then you raise equity for deals. But of course, just to start with, tell us about yourself, how you found this space, what you do kind of right now with your time and whatnot. It's obviously you like to have a lot of fun. So, tell the show about yourself.
Thanks, Craig. Yeah. Well, I guess I'll start with growing up, I grew up in an aviation family. I'm actually a third generation airline pilot. Uh, two uncles who were airline pilots, and I learned to fly when I was 11 years old. And that unlocked some pretty incredible opportunities and experiences for me when I was young. Got my flight instructor and commercial license when I was 18 years old, moved to California, and had access all through college to airplanes and was teaching people how to fly throughout college. I caught the real estate bug when I was in high school. I almost took a left turn and went into real estate in college, but you know, the aviation bug was strong, and I really loved the flying aspect. So found that career path that has been incredible, very fun. It's a passion of mine, and it's been an incredible career. The great thing is that I've been able to do both. So after I about 6 years into my flying career, finally got on with a major airline, and as soon as I could afford it, I started buying real estate, and here we are, almost a decade and a half later, and I now have a private equity fund called Turbine Capital. We also host a podcast called Passive Income Pilots, where we educate the aviation community on the investing strategies of the ultra wealthy, and we bring on guests to talk about real estate and financial freedom and all the different ways that you can maximize your financial life versus the traditional stocks, bonds, mutual funds path that most people take.
Yeah, and that's a very interesting, as we call it, avatar and a very niche and specific investor or profile because you're one of them. So there's obviously a no like trust factor there. But the other part of it is, of course, pilots make good money. They've got pensions, very stable careers once you get it going. You work for one of the bigger airlines. Would love to know which airline you work for, of course.
Yep.
But it's cool that you have that specific type. Do you raise from any other people other than kind of the pilots?
We have people in our investor club from every walk of life. We have business owners, doctors, attorneys, all sorts. And that was really a function of when I started the company. It was friends, family, and one degree of separation. Sort of taking that leap of faith when you're brand new to something and jumping in, and then those referral networks starting to grow. But our key demographic is pilots, and it's definitely the vast majority is pilots on
Right.
our list.
And what airline was the first airline that you got with, a big one? And then where are you currently with the airline?
So as a pilot, it's an interesting career because it's all seniority based. So you can work harder than someone else, and it doesn't really matter. If you got hired the month before someone else, you're always going to be senior to them your whole career. So yeah, the idea is you want to get with the airline that you want to be with for your entire career as quickly as possible, because the sooner you get on, the better seniority you're going to have as people retire. There's mandatory retirement age at 65 years old, and people get hired underneath you, and that's how you sort of move up, and everything is based on seniority, from how we bid our schedules to whether you're a first officer or captain. That's a choice based on what your seniority can hold, to what base you're in. So I started my aviation career in Southern California. I left Hawaii. My mom's side of the family is all from Hawaii, and grew up on the mainland until I was about 13, went to high school out here in Hawaii, and then bailed to Southern California, did my flying and had a blast with that. Flight instructed, flew cargo. Then I moved to Albuquerque, New Mexico, and flew, it's called a Cessna Caravan, 208 Caravan. So it's like those, I mean, people who aren't in the aviation industry would call them puddle jumpers. I think as you're moving up in your pilot career, that feels like a big airplane at the time
Right.
because it's turbine powered, and it's slinging a propeller, but it's actually a jet engine behind, under the hood. And so flew those. It's like 9 passenger out in New Mexico, and at the time, you're really paying your dues, and the industry has gotten better since then. But you really had to pay your dues back then. It was a continuous duty overnight where I would take my suitcase with a sleeping bag and a pillow, and we would fly down to Carlsbad or Hobbs, New Mexico, and we'd spend the night at the little tiny deserted air terminal down there for about 5 hours, and we'd sleep on the floor or on a couch. And I remember in Carlsbad, New Mexico, there was one couch. And so there were 2 crews that would go down there, and you'd race, and the first crew to get there would take the couch. So did that for about 6 months, went back to Southern California, flew Metroliners for the Navy on a contract, which is about a 19-seater twin turboprop. That was a blast. Did that, and then I managed to get on with my current airline, which is Hawaiian, back in
Awesome.
2010. So
And was that
been
always
there
the
for
goal was that always the goal to have Hawaiian Airlines as your kind of the company you work with to go back and forth between the West Coast and Hawaii basically, or
not necessarily, actually. It's funny you say that. My grandfather actually flew for Hawaiian, and my uncle, my mom's brother, flies at Hawaiian. So I'm third generation here. So it's fantastic. But it wasn't necessarily the goal. The goal was to get on with a major airline. I was in my early 20s, and it was like, hey, whoever hires first. And at the time, Hawaiian was actually the only major airline hiring. So I was very fortunate to get in at that time. So it's been 13, about 13 and a half years now, and life is good.
awesome. So tell me about your first real estate investment. You mentioned that right when you were kind of got into it, and right when you could buy some, you ended up doing that. What was that process like? Was it a house? Was it smaller units? Typically people start there and work their way up. It's very rare for someone to jump right into syndication naturally, right?
Yeah, I hadn't heard of syndication back then, and you know, it pilots are making good money now, but it wasn't necessarily the case back then. Pilots weren't making quite as much as they're making today, and first year pay is notoriously bad at any airline because it's sort of your probationary year. And first year pay at Hawaiian was excruciatingly bad. I think I made 35,000 that first year. So it took me until second year to have enough capital to deploy. And but the moment I did, I mean, I remember saving every penny I could to go out and start buying real estate. And this was in 2012, so it was a great time to be buying. But I didn't have a whole lot of money to invest, so I went to Vegas and I bought a 3 bedroom, 3 bathroom, 2 bedroom. It was a three. I know it was 3 bedroom. It was 2 or 3 bathroom home in Summerlin, outside of Vegas, and I bought that property for, I think it was 189,000, something like that.
Yeah.
It's crazy
Nothing.
how
Yeah.
nothing, right? And I found a realtor that somebody had recommended to me, and I'd read all the books, and at the time, I mean, I was only 24, 25 years old, and I was terrified. So I put 3.5% down. It was all I could afford. And I remember we closed on the house, and I jumped on a flight, and I landed, it was before Uber. I'm starting to age myself, right? But so I got in a taxi and I got dropped off at this house, and I was terrified. I looked up at this thing. I go, what have I done? This is the worst decision. The
Yeah.
the doors were open and the moving vans were leaving, and there were yard people mowing the lawn. And I was just like, oh my God, what have I taken on?
Right.
But that was the genesis of what has now become an incredibly successful investing career. And I think it speaks to the fact that sometimes you just have to make that leap before you're ready, or you should make that leap before you're ready sometimes.
Right. And I love that story. And unfortunately, you have to learn the hard way of thinking, oh my gosh, what did I get myself into?
Hmm.
Only to find a way to figure it out and repeat the process over and
Exactly.
over again, of course, and collect and stack your chips. So you bought that house, you held on to that. And then what was next? How did you kind of get into, kind of identifying multifamily real estate as something you wanted to invest in, but also, pool equity together for and, raise funds via the fund to fund program that you do?
So I'll start with the multifamily stuff. So, my goal initially, I didn't know what my goal was. I didn't have a goal. It was just buy real estate. And the only thing I knew how to do was buy residential properties. And so I started with that. And then I got a little bit smarter and I thought, oh, wow, okay, you can force appreciation in commercial real estate. So I should jump into that. And so I bought some small multifamily out in South Carolina. Why South Carolina? Well, the rent to value ratios in Hawaii, where I was living most of the time, um, are really tough. It's tough to make anything cash flow in Hawaii. It's a great market. If you have $1 billion and you want to park money, this is a great place to invest, but it's not a cash flow market,
Right.
particularly in residential. I mean, cap rates are usually below 4%. I mean, they're just crazy. So um, I needed to go to a market because I was trying to make my money work for me, work hard for me in a cash flow sense so that I could get that snowball going. So I went out to South Carolina, bought some small multifamily, and that was challenging because I was 6 time zones away. I'm chasing contractors and property managers that don't have a whole lot of vested interest in my 6 unit multifamily or my other property. It's just you can't motivate someone a whole lot by giving them $400 or $500 a month, which was the 10% management fee on that, right?
Right.
So about that time, I started attending real estate conferences. The first one I went to was Best Ever in Denver. I actually met Rob, and this was 5 years ago, something. And
Was
if
that like
Rob looks,
2018 or 2019 or
it must have been 2018. Yeah. And
because that
I
could have
tell you
been
what,
that might have been the same conference. Funny enough, Rob and Kent met, believe it or not.
is that right? So I tell you what, if Rob looks young now, if anybody's listening to this, you think Rob looks young now? He looked really young back then. But he still was wearing that suit and tie.
Yes.
So great.
Trademark.
The trademark suit and tie. So that really opened my eyes. My goal going into that conference was to expand my network, um, make friends in the industry and be able to lean on people for, hey, what should I be doing with this? Or do you have a good real estate attorney in this market? Or where are you buying? And hey, do you have a broker I can connect with? That was the goal. But instead, what happened was uh, I learned about syndication and I learned that I could do this hands off instead of hands on. And that was life changing for me. Because right about that time, I was upgrading to captain. I was making a lot more money. We had just signed a new contract with the airline. Pilots are union, so we go in about 5 year contract cycles, and we just got a nice increase in our compensation. So I was making great money in my W-2 at that point, and I'm going, okay, do I really want to be uh, pounding my head against a wall here on my days off? Um, buying multifamily in high cash flow markets, which are unfortunately very far away from where I spend a lot of my time? Or do I want to just invest and diversify with all of these fantastic operators across all these different markets and different asset classes? So I began investing in storage, in industrial, in mobile home parks, and some deals went well, some deals didn't go so well, and but learned along the way, learned a lot, and found myself in a position that I knew more than most any other pilot that I could come across when it came to the real estate investing space, and at the same time rubbed shoulders with a lot of doctor groups at these conferences and realized that no one was curating that type of environment for the aviation community. And in a lot of ways, pilots, I joke that pilots are just like doctors. We make a ton of money and we're idiots with it. Pilots are famous for spending all their money on boats, cars, divorces, just
Things that depreciate don't go up in value, you mean?
ex
Yes.
exactly. Yeah. Yeah, I can't tell you how many captains I flew with when I was a young first officer where they're making, three, four, $500,000 a year, and these guys are broke,
Right.
absolutely broke. They've got multiple ex-wives, and but they got their lake house, but they're
Yeah.
living paycheck to paycheck. Um, so, I really think that I found a calling where it was, hey, this isn't just a business opportunity. This is something that this professional demographic needs. It needs access to this type of education, this knowledge, and this investment product. So I founded my company in 2020. We now have raised about 27 million from private investors. We're invested across nearly $1 billion in assets across the Sun Belt, including with Lone Star. We have a very rigorous process of selecting operating partners to do business with, and I'm very proud to be partnered with you as one of the about half dozen operators that we work with. And yeah, so Turbine Capital is the private equity firm. We find and vet large scale commercial real estate projects across a gamut of asset classes, and then we also host the Passive Income Pilots podcast, which is sort of becoming the educational arm of our company and sort of a standalone education platform for aviation professionals.
And that's with Ryan Gibson, correct?
It is, and I actually met Ryan at that same conference. And little known fact, if anybody knows Ryan Gibson from Spartan Investment Group, Ryan
They're
flies for
awesome,
Delta.
by the way.
They
Yeah.
are. They're fantastic. Ryan flies for Delta. He hasn't flown in quite a while, but that's how we hit it off when we met at that conference.
Yeah, no, he's a stud. He actually spoke at our conference. Just for the guys who don't know, Spartan and Ryan, they do self-storage, if I'm not mistaken, maybe a couple other products, but mostly self-storage, and they crush it. Quality enough where Rob gave the invite to come to our event in 2022 for our summit there to speak there and drop some of his knowledge. And he's got a lot of it. He also has the most comfortable beanie I've ever received ever from a conference that I was wearing all summer trip in Oregon, but that's neither here nor there. So that's how he got into capital raising, of course. What type of deals do you raise for? I've seen you maybe do oil and gas. I obviously am on your distribution list. I think I've seen oil and gas. I've seen some maybe build to rent in Colorado, obviously multifamily with us. So what's kind of your thesis there? What do you look for in regards to I guess, the asset type?
So we try, the benefit of being a fund and not an operator is that we can be fairly nimble and offer sort of a diverse set of asset classes to our investor group. We have investors that are focused on cash flow. We have other investors that are focused not on cash flow at all. They're in their mid 30s making great money. I don't need the cash flow. I want the highest possible returns. Obviously with risk mitigation, but they're not cash flow investors. So we want to try our best to curate a diverse set of offerings, which kind of mirrors the way that I want to invest my money. I joke that I have created this perfect holy grail investment vehicle for myself through this, because now with a fund behind us, we have all of these resources and this expertise to do due diligence, and we can be nimble and attack many different asset classes. So we run about a half dozen deals per year. We did our first energy deal last year. That was the culmination the culmination of about a year's worth of work to understand that asset class, because it's difficult, and it's difficult to find operating partners that are trustworthy and the right segment of the market to invest in. But I would say that the core of what we go after is storage, mobile home parks, multifamily, and industrial
Well, that's awesome
on the real estate
because
side.
yeah, I mean that's awesome because it's such a basically wide array, and you get to hand kind of select and pluck what the best deal is that comes up, and you can kind of handicap it accordingly, right? Because 20 IRR, or let's just say a 15 IRR multifamily or self-storage, or mobile home parks, well, it's all kind of created differently. So you can kind of analyze what best is the best opportunity, and truly just be diverse in that regard. A lot of people are not diverse like that. I'm going to be probably very heavy in homes, or multifamily, of course, and then homes. That's just my thing, what I know well, but it's nice that you
Right.
have kind of a finger all over the place. And with that said, when you do vet a sponsor, what do you typically look for?
Well, we start with the sponsor for sure. The first thing we look for is the track record, the length of the time they've been in business. It's funny. I there's so many analogies that I can pull between the aviation world and the investing world. So I look at the investment sponsors, the pilots, right? So, what does everybody want to see when they get on an airplane? They say, I want to see somebody with gray hair, right?
No, I want to see
Oh, that
someone who looks
doesn't.
like you, actually. I disagree. If I'd be like, hey, that guy, yeah, you can fly my plane. He looks old enough where he has been through a couple of storms in his day, but
Yeah,
not a dinosaur where he doesn't have the dexterity or the
absolutely.
cognition to make it happen. So I would
Completely agree.
love to see someone like yourself. Yeah.
And I can tell you, so I'm gonna, and I'll tack on to that because I can tell you that just because someone has gray hair doesn't mean they're a great pilot, right? It has to do with their experience. It's not their age, it's their experience and the quality of that experience. So if somebody's been flying the same airplane from the same destination and the same departure and destination for the last 10 years, their skills outside of that specific route are going to atrophy. But if they've had a really diverse and challenging skill set, if they've been, instructing in the simulator, if they've been, in the training department, if they've been flying, different airplanes to different destinations in difficult weather, with all sorts of things that have come up along the flight, whether it be weather or passenger issues, or then that's going to be higher quality experience, and that will create a more dynamic flight crew, right? So the same thing that we look at in an investment sponsor, it's like, okay, what is their track record? What is the quality of their experience? So we want to look at what have you accomplished and in the face of what. So one thing that we'll do with newer sponsors, we'll say, okay, we want to see your track record, but we want to see the original pro forma of what you did, and then we're going to strip out all the organic rent growth. So if you bought something in 2020 and you sold it in 2023 for a really big gain, it's like, well, you didn't really do much. So that, or maybe you did, but we need to strip out the organic rent growth from the original underwriting to see sort of, how that teases out. So we try and kind of really look under the hood in terms of what that experience has been, and that builds the character and the skill set and the knowledge and the acumen to carry an investment that could end up in a difficult situation depending on external factors, while we're in it with you. I say that the investors are like the passengers in a syndication deal. The LPs are the passengers on the airline, and then all the contractors are the maintenance personnel and the ground handlers, and we're there as an inspector, right? We're the FAA. We're coming in, we're scoping the engines and interviewing the pilots and saying, okay, is this a safe flight? And then where are you going, right? That's like the flight plan, the A to B. Where are we departing from and where are we going? That's the flight plan. And what's the weather going to be along the route? That's the economic conditions. So what is the weather forecast saying for the next 2 years? And do we think it's a good idea to take off right now, or not? So those are all the sort of the things that we put into our diligence process. Obviously, it gets a little bit more granular and detailed than that, but it's a good way to think of it, I think.
I think that was a really incredible analogy. So thank you for the detailed breakdown there. And that's a great way to look at the perspective there and how to audit the situation. So that's really, really cool that you broke it out like that. And then, when you do find the right, the team, crew, plane, pilot, so on and so forth, what are the metrics that you look for? Because you're obviously, as I said, you've looked for 4 deals in multiple asset classes. How do you handicap them, and what are the metrics you need to see for you to say yes to a deal? Because I'm sure you get pitched left and right. You're obviously pretty public. You raise, obviously $27 million is not an insignificant amount of money in that short period of time to start. So, what are some things you have to see to get excited?
I think that the sign of an amateur investor is one that looks at 2 deals and says, well, this one has a 3% higher IRR, so I think I'm going to go with that one. When you look at metrics, return metrics are return metrics. I mean, we joke, Rod Beardsley is an expert underwriter, And I mean, we could joke with Rob that, hey, Rob, what do you need to give a 18% IRR? It's like, oh, easy. We just change these couple little numbers and boom,
Yeah.
there's your 18% IRR, right?
Yeah,
So
we put it to a 4.5 exit cap. Well, there you
there we
go.
go.
Yeah. Yeah.
Easy. You just tweak a couple things in the underwriting and there it is. So the metrics, the project in terms of metrics, if we're talking about projections, I take all of the projections with a grain of salt. The projections are that shiny exterior of the car, and the underwriting is where you pop the hood and actually see what the engine looks like and what the transmission looks like. I think of the operations team as the transmission. That's the one that takes the business plan and actually takes that power and puts it to the wheels, right, on that day to day. So what gets me excited is the story, and I think that's what gets our investors excited is the story. Okay, like why is this an attractive deal? I don't, if it's a 17% IRR or a 20% IRR, that doesn't tell me anything. It's like, okay, where is it located? What is our unfair advantage in this deal? What's the business plan? What's I mean, we did that. You alluded to the deal we just did in Colorado. We normally wouldn't touch a land entitlement deal, but we got it under contract from a Canadian hedge fund that had no idea what they had. They had listed it for about 50% of what they should have listed it for, and then we retraded down from there. They just wanted it off their books, and all the entitlement work was almost done. When we first started looking at it, we thought we were going to have to do all the entitlement work. Turns out it's already on an approved planned development district. So those are those deals where it's like, okay, this is exciting because this is special. We have some unfair advantage, and that's the beauty of real estate is that insider trading is legal, right?
Yeah.
It's
It's
the
all
norm.
information based. Right.
It's
Yeah.
all information based. So if you have information that other people don't, then that's what gives you that unfair advantage. So we look at for asymmetric return profiles where we have an outsized upside, the potentiality for outperformance to the upside with very little downside risk.
Right. And I'm sure you obviously handicap on a case per case basis, something like
Of
this,
course.
right? Where it's like, hey, you probably won't normally do that if it was offering a similar multifamily return because multifamily is
Right.
so stable.
Of
But well,
course.
hey, you look at like the deal we did, obviously with Lone Star, not the highest IRR you've seen, but with the
No, but
PFC
very
HFC.
stable.
Exactly, with the PFC HFC portfolio, it was a very clear downside protection play, in a looming recessionary environment where, instant value creation day one by eliminating
Absolutely.
a huge key to the financial ingredient there of property taxes. So you eliminate that,
Absolutely.
huge bump. So it's fun and refreshing to hear that perspective and the thought process there, and the true forced appreciation play to real estate. And I think about anything as well. There's some deals you can buy well, and you're going to get cap rate compression. I think like the deal I just shared with you in Houston. So there's
Yep.
situations like that are kind of market blips, and then there's the true value add appreciation play where you're forcing it. So there's more than one way to skin the cat to get bigger returns.
Absolutely. Couldn't agree
Yeah.
more, Craig.
So when it comes to your angling for getting investors, would love to hear your perspective on that and how you kind of attract them and get that, because raising $27 million, not a small feat, and that's all retail, friends and family referral money. That's different than going out to some fund and getting a big check for 10 million. That's a lot of investors, I have to imagine. So what's kind of that process like for you? Where do you find them? Where do you look for them? And the conversion process associated.
It's a great question. Um, so until very recently, we have been much more focused on uh, plumbing, for lack of a better term, infrastructure, fund administration, customer service, building the foundation of what is going to be a much larger house. So we have not been particularly focused on growing our list. So most of the leads that we get today are organic referrals from people who have invested with us and have been shown a great experience and are repeat investors. That now that we have the infrastructure in place in terms of being able to handle a large volume of inbound leads and ability to handle, requests for example, hey, I want to move my interest into a trust. It's like, well, we need to have a process for that, and we need to have a team member that can handle that. So now that we have those pieces in place, we're sort of turning up the volume on marketing a little bit. We're going to be attending 4 aviation conferences this year. We'll be sharing with the pilot community what it is that we do and how we do it. The podcast that we launched last year, Ryan Gibson and I co-host, launched last April. That has been fantastic. That's been really kind of spreading the good word to the aviation community. We have a lot of people coming in through the podcast saying, "Oh my God, you've opened my eyes to this whole other world of investing that I didn't know existed." And a whole different way of thinking about money, which I think is really important. I think a lot of high income W-2 professionals get stuck in this earn money, save money mindset and don't put a whole lot of effort into making their money work for them, and work hard for them. So that's been a good lead source. And honestly, I'm more concerned about doing the work day after day and focusing on our operations and focusing on doing great deals and letting the business grow naturally than puking videos all over Instagram and trying to go for the sugar high.
Right. So you're basically very intentional with just best service, and then everything will kind of work itself out with regards to referrals, basically, is kind of the philosophy and the perspective you have.
Exactly.
Yeah, and then you also, of course, have the podcast. So, I mean, it's such an easy way for people to get familiar with you, learn about yourself, your philosophy. And it's funny, more and more, and I've been doing it for not as long as you have, even because we started really ramping up in, I want to say, May and June of
Mm-hmm.
2023. But it is crazy the amount of engagement. And then also when you speak with someone, they kind of feel like they know you. Such a
Right.
easier
Yeah,
conversion process when someone has spent some time with you, even if it's just an hour to get a feel and flavor of who you are. Super crucial. So I love that you're obviously experiencing those benefits as well.
absolutely.
Yeah. And it's funny. I know you. I've obviously seen your Instagram. I obviously we're friends on Facebook and whatnot, but
Mm-hmm.
you're someone who has probably a different perspective. And you said something there before with your relationship with money and whatnot, and how that looks. I feel like you have a very great work-life balance. You obviously work very hard. You're doing this on top of, a robust pilot career, but it seems as if, you really enjoy life as well. Is your relationship with money just, I guess, different than most people, would you say? Because you obviously live a very full life of traveling, doing fun things and whatnot. And I feel like you live life, which I really respect about you, on your own terms. So would you say that's definitely a point of emphasis and why you got into the capital raising world as well?
Well, I definitely would say it's not why I got into the capital raising space. I got into the capital raising space because I realized that I loved looking at deals and loved analyzing deals and I loved investing in deals, but I didn't love managing them.
Right.
So, I love the position that I am in now, where we're on the capital side, where we can find great opportunities and then hand the reins over once we write the check to an amazing team like yourselves to manage the day to day. And you know, I think I was doing a lot more traveling before I started this company. This has been definitely a hard few years of building, but it's been worth it. Especially being able to change the lives of pilots, and not to say that pilots weren't fine before. I mean, we have great 401(k) plans, and we're fine, but we're elevating the level of success of the pilot demographic, and of course of anybody else that wants to join our list. So that's been really cool, and I have phone calls every week now with investors that are saying, "Oh my God, thank you for creating this, thank you for creating the content on the podcast, and thank you for making these types of investments available to this professional demographic." So that's very rewarding. In terms of the travel, yeah, I've been a travel nut from day one, and I think I probably would have been a little bit more successful in real estate early on had I not been traveling so much. But I tell you what, if I have any advice for young people, it's that you're going to live to, if you're in your 20s today, you're going to live to 120 because of the regenerative science that is here today, and because of biotech. I mean, it's just incredible the technologies that are coming up that you will intercept in your life. So if I have any advice is that if you're in your 20s, don't be in a crazy rush and make sure you travel and create relationships, because I spent a lot of years traveling all over the world with my best friends and sailing in the Mediterranean and skiing in the Rockies. And I mean, just having an absolute blast. So yeah, we try and balance that. My wife and I try to balance that as best we can now. We met sailing in the Caribbean, and we both work really hard. We both have a business now, but we try to, have a sailing trip where we sign off, at least once a year. We're going to Greece this summer. I'm in training on a new aircraft right now, but as soon as that's done, I'm going to go and round up a group of friends and go on a ski trip. So I think it's really important. The Tim Ferriss in the 4 Hour Workweek talks about mini retirements, and I always love this because a couple times throughout my career I've taken 2 straight months off, and at the end of those 2 months, I'm ready to go back to work. So the goal shouldn't be work really, really hard until you're 50 or 60 and then quit and do nothing and just lay on a beach. It's like, you got another 60 years to live, man. Like, you're gonna have to do something with that time. So there's, be diligent. Compound interest is powerful, and getting started 10 years earlier is going to have a monumental impact on how you can live your life in your later years. But don't get so caught up in chasing money that you lose track of having incredible experiences, because you want to have those experiences when you're young and when you can enjoy them.
I think it was very well said. So I respect that so much. Funny enough, I don't know if we've talked about this before. Maybe we've touched on it, but prior to me moving to Phoenix from the Bay Area, I got the opportunity where I had no rent, no car payment, no bills, no anything. So I had a month
Wow.
gap between double ending my last deal in the Bay Area to moving to Phoenix. And I was
Amazing.
like, well, I might as well go to Asia. And the significance of that wasn't just the fact that I got to go to Asia. I got to go to Thailand and Indonesia and Bali there. And I got to go for a month from basically Thanksgiving to Christmas. But the significance is 3 months later, COVID happened. And had that not happened, and I didn't go in that exact window in that sliver of time, I probably
Yeah.
would have not gone to the state, which is scary to think about. And I would have this sense of regret and, oh my gosh, what if? And I would hate to put that on the back burner when you can definitely prioritize it. You might have to make a sacrifice here and there to afford it, to make it happen, but definitely well worth it. And then, of course, a point of emphasis to always try to go somewhere new and go to Europe every summer, at least for my goals. So we were talking
Yeah.
about this, but want to go to Switzerland this summer, so that'll be fun for sure. But I love that, thought process there. And I always say, hey, if I get 75 to 100 years of life, that's great, but I definitely don't want to lose the prime in my youth to not traveling when I would probably
Exactly.
appreciate it and like it the most.
Yeah,
So
there's plenty of time to make money.
absolutely. So with regards to kind of the market with your portfolio, segueing back to that, what gets you most excited and nervous with everything coming on with kind of the market turning right now and pricing kind of being changing with rate volatility? What's getting you excited and what's concerning at the moment to you?
Honestly, I think that this is the moment we've all been waiting for. I laugh because my wife is a real estate agent here in Hawaii, and everybody is pulled out of the market going. And granted, inventory is very low. There's very little stuff to buy right now, but buyers are going, I'm going to wait for interest rates to go down. It's like, are you kidding me? You and 30 million other people,
Yeah, everyone else is
So
too. So
this is the I mean, this is why we jumped on, buying a house last fall, and we never would have gotten that place had the interest rates been still at 3%. So I think it's wonderful. Multifamily valuations have come down, and that's challenging for people that own multifamily right now. Valuations are down, debt service is up, and cash flow is an issue. But that'll turn around. And for buying, I think that this is one of the best buying opportunities that we'll see in this decade. So we're extremely bullish on multifamily, mobile home parks, self-storage. I'm very excited. So I know that there's a lot of construction supply coming online as well. So that's challenging. So we've got all these things that are depressants right now in terms of rent growth. But that means that if you're buying now, I mean, construction financing is impossible to get right now. So the supply pipeline is going to dry up. And this isn't just multifamily, this is self-storage as well. That pipeline is going to dry up in the next year, 2 years. And so if you buy something today, you're going to be selling it into a dry market where there's no supply, no new construction, because 2 years prior, 3 years prior, it was so hard to get a construction start because the financing was so tight. So, and I also agree with Rob. You know, I saw him post a video the other day about buying in all stages of the market cycle. I think that was a mistake that I made early on in my career, where I was always over analyzing, always trying to time the market, trying to figure out, okay, what should I buy and when the correct answer is buy, period. As long as the fundamentals are strong, just buy and then continue to buy. And that is how wealth is created, is through ownership of assets over the long term. You know, Warren Buffett said, we don't buy a stock unless we want to stay with that company for the next 10 years. We're not buying it for a quick buck. We're buying it because it's an asset. So that's my view.
I love that. And think about all those people who thought the market, me included, was going to, and I didn't really have money to invest at that point. So it's really not an issue. But in 2020, even when we all thought the world was going to end, if you pulled everything out of the market and sold, well, think about the massive gains you may have missed if you didn't hold for 2 more years to sell, in the first half of 2022. You would have done incredibly well on those investments there. So it just goes to show, buy early, buy often, dollar cost average in is so crucial to do. And, to your point about the house or just any investment, if you're concerned the market might drop, okay, well, then you're obviously an expert. I can look at it. Well, if I think the market's going to change, if I like the deal, well, I'll just structure the debt. We'll have a longer tar back where if there's a choppy, some turbulence on the flight from buying to selling, well, guess what? You'll hold through that process. Maybe you can sell someone with a long-term debt note where you can give a loan assumption and they can come in and give you, a better price than what the market could have. You could buy another deal. Or if you're, looking at a house with a 30-year debt note, okay, well, a 30-year tarmac on a house with residential financing, you can't beat that. So, as you
Yeah.
said, you want to be always deploying money in the market. You just never know where it's going to come, and get informed, get education as to a strategy and things that are cohesive to your thought process, and to mirror and match that.
Yeah, to me, the commercial real estate mirrors the residential world right now, where you date the rate, you marry the house, right? So if
Yes,
you're buying an asset, if you can cash flow at 7%, guess what's going to happen when you refi it at 5? I mean, massive increase in your cash flow, and of course, there's organic rent growth and inflation. And inflation is very kind to real estate investors. So, I'm a bit of a perma-bull. I think you have to be very careful with what you buy. The fundamentals have to be good, and you have to. I liken cash flow is like airspeed, right? If you run out of airspeed, you're going to stall. And so if you're losing power, which means you're losing income, you got to have enough altitude to pitch down and keep the wing flying, right? Which is cash reserves in the bank on a deal. So as long as the fundamentals are strong and you have downside risk protection, I'm a little bit of a perma-bull in terms of just buying it at all points of the market cycle, and with while also going a little bit overboard on diversification.
likewise. And I think the name of the game is you don't know when these massive market runs or pops are going to happen, but if
Right.
you just keep
Nobody
deploying your
does.
money in, you will capture the upside there on all the tranches you've invested over the period of time, so long as your money is still in that market, of course. So always something
Exactly.
there to be thinking about.
I think people don't people forget that recessions don't last forever. Everybody's like, oh, what if I buy right before a recession? Well, recessions only last for, even the great, 2008, property values were coming back up. The
6 months
trough only
later.
really lasted,
Yeah.
I was going to say like 3 years. I mean, things were pretty
Depends, well,
slow to
depends what market
recover.
you're in. Yeah.
Depends on
And
what
and
market,
yeah,
what asset class. But even 3 years, it's like that's not really that big of a deal. You think every syndication deal has a 5-year hold. So even if there's a recession during that, okay, your cash flow is going to suck, but oh well.
absolutely. So I like to ask every guest this question to kind of close out. What's your hottest real estate take? I'll just share mine right now. And if you're familiar with what a hot take is, kind of something maybe contrarian
Educate
or
me.
exactly something that's kind of contrarian or a little bit spicy that, most people might, raise an eyebrow at. So my hot
Okay.
take right now is I hope rates don't get cut soon because I want a longer buying window. So that might be contrarian to a lot of people, depending upon their debt notes and their personal circumstances. If they got HELOCs or something of floating or variable rate, debt note, we don't really have much exposure on that. And to your point, this window that we have right now with this market dislocation will be here and gone. So when we interviewed JC Clemens on the Capital Spotlight podcast with Rob and I, he was like, yeah, this window, this is in October, it's probably gonna be 6 to 9 months. Well, if he's correct and he's looking like he will be, that window might end in June, where it's like, okay,
Right.
we found the bottom. So my hot take is I want the rates not get cut, so there can be a little bit more pain in the market and it's slightly longer buying window.
I completely agree with you there. When I saw that rates could be cut as soon as May or June, my stomach kind of fell because I was like, oh, we
Oh,
need more turbulence to sort of shake out the bad debt. It's almost, this is like a wildfire that comes through and it kills everything off, and then the strong
yes.
regrow. And yeah, and this buying opportunity that we have in 2024 is so amazing. And if it ends in June and institutional capital floods back into the market and cap
Which
rates
it will.
recompress,
It will.
which it
I'm telling
will,
you,
it
it is
will. But
happening
if
in
it
front of
but if it
us.
but if it floods in, early, and the window was too quick to take advantage of it, it's going to be a real shame.
No, I mean, and I was just at IMN in Laguna Beach for the private equity forum there. Really special IMN event there. It's not a cheap ticket, but if you can afford to get out there and do it, I recommend everyone to do so. But the reason why I'm going there and mention that is because the JV equity groups, institutional equity groups, the family offices of the world who are managing massive tranches. These are deal makers and check sizes of 10 to $30 million, for programmatic one-offs, and even sometimes more in some instances, or a little bit less, right? But they are right there, ready to go, and are sitting on cash and are just frothing at the opportunity to deploy it. So you're right, that money will come back into the market. So that's my
Well,
take. Would love to hear yours, unless it's the same exact one, because we're such good thinkers.
you know, um, no, I mean, I completely agree with that. I'm trying to think if I have some, you know, uh, some wisdom that's unique to me. I don't think I really do. I think that, if we do see a bit of a slowdown in consumer spending, I think that will permeate the market. I think people think that as soon as interest rates come down, that it's just going to be, full throttle again, and everything's going to be off to the races. And I think there's a bit of a push and pull there, where the drag on consumer spending is going to be a drag on rent growth. And so there's it's not all sunshine and rainbows, post Q3 2024, when we expect rates are going to start coming down. But hey, turbulence is what we're looking for, because that's where the buying opportunities happen.
Absolutely. Once more, where can people find you? How can people get a hold of you?
Yeah, so I just released an ebook, actually, that I spent the last 6 months writing. Turned out to be more of a small book. I think it rivals the small books that Rob writes, which I
Right.
love.
Right.
It's
And for
called
this,
it's called
for us dyslexic people, we love those as well.
Yeah, it's nice because it's not as big a commitment, right? So anyway, it's called Auto Flight: The Pilot's Guide to Passive Investing in Real Estate, and it's available on our website if you'd like to check it out. Our website's Turbine Cap. So Turbine Capital, it's obviously a play on a jet engine. Turbinecap.com, turbinecap.com. You can check us out there. We have an investor club if you'd like to join. We participate in a bunch of different asset classes with great operators, Lone Star included. But in any case, that's how you can find out more about us. And feel free to reach out to me as well. I'm Tait, Tait, at turbinecap.com.
Awesome. Well, thank you so much for coming on the show, working with us, collaborating with Lone Star Capital. Thank you for listening to another episode of Fun Friday. We'll catch you next time.
Thanks, Craig.